Okay. Hello, everyone. Welcome to the nice class. All right. So today will be exciting. We're gonna go into the mortgage fundamental, mortgage process, and all the MLO activities starting this point on. Right. We already done with all the laws and acts and all that. Right. For the past 8 classes. It's amazing that I absolutely dedicate 8 classes for just laws. Okay. But today we're gonna go forward with the all the activities, right? So it's a nice class. I guess probably that we're gonna have you know maybe one or two, actually more than 1 week to complete all this, and then we're gonna do some examination preparation. Okay, so nothing changed here. Okay, the laws I still keep this page in here. Okay, so now we're going to touch base with the mortgage fundamental, right? The basic understanding, knowledge about mortgage, what it is, right? And the whole process, the whole big picture of the of mortgage and lending. Okay, so the mortgage fundamentals include the key terms of uh, like terms, principal, processes, borrowers, lenders, homeowners, right? All these key terms should be familiar with dealing with the mortgage loan. Here are some of the most important mortgage fundamentals. First is a mortgage loan, right? A property, unless it's paid in full by cash, it should have a mortgage loan, meaning somebody go out and borrow the money from a bank, from a lender, to pay for that property, and then they can have probably they don't have to borrow the entire 100%, and not all the bank or the lender will lend 100%. But there's some exception though, right? Take that into account. So some people, like most of the people, think that they have to down 20%, right? But that is not entirely true, and that is your duty and your goal to go out there and explain to the borrowers that you don't have to down 20%, and you don't have to wait until you have enough 20%, right? You can down as low as 3%, 5%, 7%, 10%, 15%, right? You don't have to wait until you get enough money to pay for down payment. So that is a misconception between the down payment from a lot of people, especially the young generation, because they don't know about it, right? So the thing is that if you want a client, right, you have to ask that question: how much you have down, right? And if that's a new client, new buyer, first time homeowners, first time home buyer, right? They may not understand this whole thing, but you do, you understand this, right? And then you have, I only have 17%. I don't have. Maybe I should wait another year until I got 20% and now buy. You stop them right there, right? You don't have to wait for you to get enough 20% to buy. You can buy as low as 15, 10, even 5 or 3%. Okay, so that way you can get a client right away. Okay, but sometimes even if they have 20%, okay, there's some strategies that you have to play with. Okay, so that to give the buyer the purchase power. Okay, let's give an example. Okay, let's say if this buyer is qualified to buy a home at $1 million, and then he or she have 20% down, right? But it's happened that we are actually in a seller market. What is a seller market? A seller market meaning there's less home to sell and a lot of people want to buy. It's called a seller market. Or there less seller than the buyers, right? Let's say 5 times, 10 times of the buyers than the sellers. That is called the seller market. Vice versa. If it's more if it's more more buyers, or let me see, this way. If it's fewer buyers but a lot of sellers, then that is in the buyer market. Okay, but now we're talking about the seller market. So in the seller market, right? There's a lot of competition. A lot of buyers are going to compete with each other, right? So one of the strategy that you can use is that you can tell your client, you don't have to down 20%, because if you down 20%, then you can only purchase at $1 million, right? But in this market, house is gonna pay more, so that you can buy the house. So the way that you can buy that you can buy that house at a higher price, more than $1 million, maybe let's say $1,025,000, okay? And then what you need to do is lower your down payment. You can lower it to 17%. That gives you at least 50 grand or 100 grand more to pay for the higher price. If you feel that home is worth it, okay, it's worth for your family, right? It's meet your family criteria, or it's also like a beautiful home in a good school district, good neighborhood, and all that, right? All those are the facts, right? The home worth is not only its value, but the community, the lifestyle, and all the associated fact regarding to that the property, right? It's how it's calculated worth, right? It's not just only the price is worth, but all that is matter to the buyers, right? How we're going to calculate the worth of the asset. Okay, so meaning that you don't have to down 20%, but you can down 17%. So that instead of maximum yourself at 1 million, now you can raise yourself to 1,050,000, 1,075,000. Okay, so how is that possible? It's possible because, like, when you lower your down, right? Let's say you have to have $200,000, right, to buy $1 million for 20%. But if you lower to, like, let's say 15%, right? 15% of $1 million is $150,000. Meaning now you get $50,000 more that you can raise the price, compete with any other buyers, right? If you're lucky, you may buy it at $1,030,000, right? So that is how powerful when you lower the down payment, okay, and then get the price higher so that you can outbid other buyers, right? So that's just an example. But when you lower your down payment, meaning that you now have to pay the PMI, okay? The PMI is what? The private mortgage insurance, okay? So because your threshold, you below the guideline of Fannie Mae and Freddie Mac, okay? Then now you have to pay the PMI. And guess what? During the time that there's a lot of competition, and I already explained this in the previous class, that there's a time that the competition is high, the lender will calculate all that PMI upfront, let's say $6,000, and the lender pay it off for you too. So that way, even you lower to 15%, you still don't pay the PMI, right? So, like I said, it depends on the market as well. So right now in the market, yes, you may have to pay PMI, but let's say 2 years ago, back in 2021, right? Then the lender pay for the PMI too. Okay, so mortgage loan is something that must have to buy a property. Okay, so in the mortgage loan, you're gonna have a mortgage payment. A mortgage payment gonna divide into two pieces. One is the principal, meaning that when you put in the mortgage payment each month, portion of that money will go to the principal, right? Pay lower your total balance, and also portion of it go to the interest rate, right? Or to the interest, right? To pay for the interest based on the interest rate that the bank or the lender is charging, right? Keep this in mind. If the lower the interest rate, the higher principal that you're going to pay into a monthly, okay? If the high interest rate, the lower the principal you're going to pay it, into the total balance. So let's take an example, right? Let's take an example of, let's say you pay $5,000, a total of $5,000 for a monthly mortgage payment. If the interest rate is like roughly about 2.75%, then your principal probably about 40% of that total amount that you pay. Meaning that if you take 40% of 5,000, okay, so that is like 2,000. 2,000 go to the principal, 6,000 go to the interest. If you have a 2.75, okay, now let's say you have a 6.0, interest rate, then guess what? Only probably between 17 and 20% of that mortgage that you pay each month go to the principal. So let's say round it up to 20%, then only 1,000 go to the principal, 4,000 go to the interest. So you see how the difference between interest rate affect how your monthly payment go into principal, right? So take a look, so meaning my rule of thumb when I'm investing in real estate is that I'll buy when there is interest rate low. I sell when it's appreciate a lot, right? And I hold, when the rate is high. Okay, so and also when the rent is good. Okay, so the second piece of this in the fundamental is that the principal, you need to pay back the principal, right? The initial amount of money that you borrow from the bank, from the lender. Okay, the interest rate is a factor on how you're able to get the loan, right? The lender say if you want to borrow $500,000 in this particular market, based on your income, based on your credit score, based on your debt, the DTI, now you get a rate of 5%, or right now maybe 6 or 7%. Okay, so that interest rate determine of how the lender charges you so that they can lend you the money to buy the property, and then that interest rate dictate on how you're going to pay back each month, including principal and interest. Okay, the next piece is the amortization, right? Thinking about let's say a 7% interest rate, right? Let's say if you borrow 500,000 at a 7% interest rate, and then if you calculate that, that's gonna mean if you take 7% of 500,000, that is roughly $35,000. $35,000 you divide by 12, right? That may be $3,000 a month. Okay, actually, let me do a quick calculation here. Okay, so let's say if you borrow $500,000 on the interest rate of 7%, so that $35,000 total. Okay, but usually interest rate is charged per annual. So if you take that, you divide by 12. So meaning that you pay roughly, $3,000 or $2,900 a month. Okay, but guess what? That is the way of calculating the interest rate of a credit, not for the housing. Because okay, I say 5,000, 500,000, right? What happened if I borrow $1 million? Okay, and I say if it's upon 7, then I pay $70,000 a month. How the heck am I going to be able to pay $5,800 a month, right? And that is only interest, not principal. So that calculation is just only used for majority of the credit card, not for the mortgage. The mortgage is have its own way of calculating. It have its own formula of calculating. So even with a 7%, right, and the amount of money that you borrow, they're going to calculate a total maybe 4,000, but that 4,000 may include principal and interest, not just only interest, right? So that calculation going to give you a mortgage payment for each month. And let's say if you borrow for 30 years, that is 360 months. Okay, and each month you're going to pay the same. And guess what? 360 months. Let's say we have month number 1 all the way to month 360. At the month number 1, you're going to pay more interest, less principal. But as far as you're going down, let's say halfway, right? You're gonna pay more into principal and less on the actually I should say like a third of the way. Okay, you pay more on the interest, less on the principal. But once you pass that 10 years, right, you're gonna pay more on the principal and less on the interest. And as long as you go down to the 360th month, then you're gonna pay majority into the principal. Okay, so that is a calculation gonna do that. And then for these 360 months, right? Each month is the same payment, but the amount of money going to go to principal and interest is different each month. And that is called amortization, right? They amortize it over 360 months, right? Each month, same payment. And the payment for each month, the amount, a portion of the amount goes to the principal and a portion of the amount goes to the interest. So that is what is called amortization. Okay, amortization depends on several factors. First, the interest rate. Second, the monthly payment. Monthly payment will be the same. Third, the principal. Principal will be less at the early months and got to be more at the at the later months, right? And the interest that you pay each month, interest will be paid more at the early months and pay less at the as we close to the 360 months. Okay, so that is what it's called amortization. Okay, down payment. Like I mentioned, right? You can have money to down. You can down 20%, 17%, 10%, 15%. That is what it's called down payment. It's the money that you're going to bring in during the transaction of buying the property. Okay? The loan term, you can decide that you want to go 15 years, 20 years, or 30 years. The loan term here is also applied not only to purchase, but also to the refinancing too, right? Some people that when they purchase, they pay they pick the term of 30 years, but as years come by, right, they pay it up more, and now that's a good rate. They're gonna be they want to refinance, but they say, okay, I don't want to wait for 30 years, right? I just want to pay it off with 15 years. That's just a mentality. That's just philosophy of how people want to own that property outright, right? So they want to pay 15 years, and now they go with a term for 15 years. So they can go 15, 20, 25, 30, whatever they want. Okay, so that's just called the loan term. When you take this and you multiply by 12, right? 30 you multiply by 12, that is 360 months. Okay, 20 years, so you can calculate it up. Okay, so monthly payment, like I say, the monthly payment is based on the amortization formula. It's calculate, let's say, 3,800 a month. That is how much you pay a month, and that is the same for all the months of your whole terms. Okay, 360 months. Okay, and if the let me say the monthly payment is the amount of the borrower must pay each month to cover for the principal, interest, property tax, homeowner insurance, and if any applicable private mortgage insurance. Okay, this right here is called a monthly payment. It doesn't say a monthly mortgage payment. Okay, the monthly mortgage payment is using the amortization formula to calculate it. Okay, and because this is a monthly payment, so it's including, let's say if you like like Jung asked earlier, right? If you have an escrow account, then the escrow account will pay the monthly payment, which including the mortgage payment. The mortgage payment is including principal and interest, and the property tax, the homeowner insurance, and any applicable PMI. Okay, PMI is a private mortgage insurance if you down less than 20%. Okay, so we already explained this. The private mortgage insurance is you have to pay that amount, whether it's $79 or $325 a month, right? And you're gonna pay that monthly. The PMI you pay it monthly. The property tax and the home insurance you can pay, for the insurance you pay like depending on how you set up with the insurance company, but majority of the time you pay yearly. The tax you pay twice a year. Okay, so you remember there is the law that say, I forget which law it is, but that say that if your equity is growing above 22%, then the lender, the servicer will stop you from paying the PMI. If you reach the 20%, then you have to call into the servicer or the lender and say, hey, I already passed 20%, stop the PMI. Okay, it's kind of a fun fact is that, let's say if the market appreciates so fast, right? So now you reach the 20%. And you call in, tell the lender, I'm reaching 20%. I don't want to pay PMI anymore. The bank say, okay, yeah, you're right. Your house is worth more than this original amount. So now you get your more than 20% equity. So we're gonna drop the PMI, so you don't have to pay for it. Let's say a year from that point on, the market dropped, right? The market dropped, and now you probably go back to like 19% or 18% or even 15%. Guess what? The bank is not gonna make you pay the PMI because that is already canceled. Okay, so take a note of that, right? The appreciation, if it's go up, it's help you to get rid of the PMI. But if it's happen after you cancel it, it's happened to drop, then you don't have to pay the PMI either. Okay. However, if before you cancel the PMI and the market drop, then you're gonna pay the PMI longer. Okay. Okay, fixed rate versus adjustable rate. Some people have a good credit, good income, good job, stable job, good down payment, good credit score. They're gonna get a good rate, so they're gonna go with fixed rate. But sometimes depending on the strategy, because not only the purchaser is the one that live in the house, but sometimes there are investors, right? People that buy a home and for investment only. And then they probably gonna choose the adjustable rate mortgage. What is the ARM? What is adjustable rate mortgage? It is say that it will be fixed for a certain number of years at a certain rate, and then after it past that number of years, the rate will vary. So whatever the market is, that rate will be applied. Okay, so meaning like let's say if you have a 6% for a 5 years ARM, meaning that you're gonna get the 6% for 5 years, and then after 5 years, whatever the market rate dictate, that is your rate monthly. Okay, and at that point, you're gonna decide if you want to keep that floating rate or you're gonna refinance so that you get a fixed rate. Okay, so the ARM pretty much is a temporary rate that you're gonna keep for a short period of time, and then you're gonna decide if you want to still keep it or you want to fix it. Majority of people want to be safe, so they're gonna fix it. Okay, fixed meaning that your monthly payment gonna be the same. If you keep it, variable, then your monthly after that period will be, varies. Sometimes it go lower, but if the rate go up, then it's gonna go up. Okay, closing costs. When you open a loan, there's a lot of associated costs, fees, right? Including title insurance, including escrow fees, including appraisal, inspection, blah, blah, blah. Those are the costs, and those are the closing costs. Meaning, why is it called closing costs? Closing costs mean at the end of the transaction, a sale transaction, all these fees, all these costs need to be paid off. Meaning that you need to bring in enough money to cover all the costs at close of escrow, at close of the transaction. Okay, escrow. An escrow account is set up to hold funds for the property taxes, homeowner insurance. The lender collect a portion of these expenses each month with the mortgage payment and pay them on the borrower's behalf. So I already explained this at the beginning of the class, right? Jung asked this question. Escrow here is an escrow account. Okay, the account that you set up after you close the purchase transaction, and then you open an account. It's up to you. Okay, it's up to you that you want to do that. Okay, and you want to open an escrow account. Some loan require you to open an escrow account, and some loan don't. Okay, depending on your qualification. Okay, so when that escrow account is open, the money you're gonna keep collect transferring from your bank account into the escrow account, so that the servicer will using that to pay for all these expenses. Prepayment refers to making additional payment toward the principal balance of the mortgage to pay off the loan more quickly. Some mortgages may have a prepayment penalty. Let's say some loan, right? When you take out a loan, that particular loan, say your loan will be, let's say, 3 years and on, then you don't have to pay the payment penalty. But if you refinance or you pay it off your loan on the first year, then you probably gonna pay a 3% point. Okay, so meaning 3% of your whole amount of the mortgage. Or let's say the second year you pay it off, then you're gonna pay 2%, right? And then anytime between the second year and before the third year, then you're probably gonna pay 1%. So they're gonna go down, right, for the prepayment penalty. And that when they add that prepayment penalty, it's a high cost loan, right? We talked about this in the one of the law. Okay, refinancing, right? So usually after you purchase and then the rate drop, you're gonna decide, hey, I want to refinance. But most of the time, you need to wait for at least 6 months before you can refinance. Okay, or we're gonna get into the case that MLO keep asking the borrower to refinance, and that's just I forgot the term. That the term is just keep repeating the refinancing, and that's bad because you're gonna pay a lot of costs and fees. Okay, so you can refinance 6 months, 12 months, whenever the rate is better, and that when you refinance, meaning that you're gonna lower your monthly payment. Okay, or the borrower is gonna lower the monthly payment. Default and foreclosure. Let's say a borrower is promised to pay $3,500 a month, but due to the job loss or health condition or whatever, that borrower cannot pay for the mortgage no more. Now, one of the smart way if that borrower were able to do is probably just rent that house out and let the tenant pay for that. You can pay for the house and you can go out and you rent or you share room or something. But if you cannot do all that, then you miss 3 payments, right? And then the bank start proceeding with notice to default. And then after 180 days, if you cannot pay back, and then you're going to go into the foreclosure. Foreclosure meaning the bank going to take the house and then try to short sell it, get their money back, and whatever left over, we'll give it to the owner. Okay, if not, then they just pretty much take the house back, put it on auction. Okay, so that they get whatever the money that they can get back. And that's what happened a lot in 2008, when a lot of people take out mortgages that they don't even qualify. When the rate going up, they just get default, and then a lot of homes get foreclosure. Okay, so today we're going to talk about, or from this point on, we're going to talk about majority of the mortgage and process and law, mortgage process and laws. Okay, and the mortgage loan process, including the application for the mortgage loan, the origination of mortgage loan, what is the title insurance with the mortgage, conducting settlement or closing, escrow accounts, we talk about this, mortgage loan servicing, we also talk about this, right? And all this have to apply to the regulation cover topics such as prohibition on the kickbacks and unearned fees. You cannot pay anybody that doesn't have license. Okay, mortgage origination and servicing, what are the disclosures? Affiliated business arrangement disclosure, right? You have to disclose it if you're working with any if you're working with any affiliated company. Title insurance and escrow accounts. Okay, list of homeownership counseling organization that that the borrower can go out and ask for questions. Okay, mortgage loan servicing requirements. Okay, what are the requirements for the mortgage loan servicer? Forced place insurance. Like if you're in the flood zone, you need to buy the flood insurance. Okay, we talk about this, right? Guess what? A lot of this is actually repeated, right? I already discussed a lot of this in the last classes, right? But this is gonna be repeated again. Just FYI, just additional information for you. But we're focusing on the loan processing. Okay, mortgage loan servicing error resolution. We talk about this too. There's a law that mandate this, right? Anything that incorrect need to be fixed. And also, mortgage loan borrower information request, whatever the information that they request. Loss mitigation, if there's any miscalculation, anything like that, need to be refunded. Okay, so we're gonna mainly we're going to focus on the mortgage process and laws, right? But these are the stuff on the right side, apply to a lot of the process. Okay, mortgage fundamental again. Qualified and non-qualified mortgage loan, short for QM and non-QM. So when you heard about the QM, that means qualified mortgage. When you hear about the non-QM, means it's non-qualified mortgage. And I already explained this before, and I'll explain it again. What is the qualified mortgage? Qualified mortgage is the mortgage that meet all the guidelines and standards of Fannie Mae and Freddie Mac. Any loan that doesn't meet the guidelines or standard of Fannie Mae and Freddie Mac are considered non-QM or non-qualified mortgage. Okay, so what are the qualified mortgage programs? Okay, the qualified mortgage programs are a category of loan that have certain less risky features that help make it more likely that you are able to afford the loan. A lender must make a good faith effort to find the loan that is that the borrower have the ability to pay back, right? Which is what we call an ATR rule, ability to repay. If your loan is a qualified mortgage, it means the lender met certain requirements, like I say, Freddie Mae and Freddie Mac guidelines and requirements. Other characteristics of the qualified mortgage, including a limit on the price of your loan. Now, some city, some county, they have a limit. Okay, let's say $725,000 is a max loan that you can take. If you want to buy $1 million home, then you have to come in with the $250,000. Okay, so there's a limit on the loan on certain zip codes, certain city. No access upfront points and fee. Okay, these are the guidelines, these are the standard, these are the requirements. If the points and fees exceed the threshold, then the loan can be considered a QM. Consider the income or asset and debt. So you have asset, you have income, you have debts, all that combined to find your DTI. And your DTI cannot exceed 43%. Okay, and guess what? There's some exception to that too. Some QM, some qualified mortgage can reach up to maybe 43, 45, still a QM. Okay, but the guidelines say 43% DTI, debt to income ratio, meaning your income needs to be more than the debt that you have. Okay, under qualified mortgage, which is also okay, under qualified mortgage rule, qualified mortgage rule is equal to safe harbor provision. Okay, remember that. Safe harbor provision. When you hear about safe harbor, you mean it's a qualified mortgage and all the rules associated with it. Okay, the safe harbor provision protect lenders against lawsuits by distressed borrowers. So meaning that if the borrower have a DTI more than 43%, doesn't have enough income, and the lender still giving the loan to the borrower, guess what? The borrower gonna sue the lender. Okay, because you provide me something that I'm unable to pay, or my ability to repay is not there. Okay, so they can sue the lender. So lender have to follow the guideline, the rule, and which is calling a qualified mortgage. Okay, lenders who issue the qualified mortgage or the mortgages that meet with the guideline can easily resell in the secondary market, right? The secondary market of Fannie Mae and Freddie Mac. So primary mortgage, primary market is the lenders, okay? Lender or investors or financial institution. They lend it out, and then because they have a limit number of fund or money, right? They can have let's say $1 billion, but after they lend it out all $1 billion, they don't have any money, and they're gonna resell those loans back to Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are government entities or government sponsored entities, and they buy back all that mortgages. Government has plenty of money, so they don't care, right? They buy back and they give the money to the lender. Lender go out and lend to a different borrower, right? And the way that lender making money is that they collecting fees, points, right? 1%, 2%. When you're talking about million of loans, they making billion of dollars. So they only collect, a couple percentage should be good enough. Okay, qualified mortgage. Allow points and fee for qualified mortgage. Assets of fund, cost and fee, right? The limit on the cost and fee will vary by the size of the loan. But if cost and fee are over the threshold, the loan can be considered qualified mortgage. Ability to repay. Some parameter that requires the 45%, 43% DTI. Lender has not charged more than 3% in point or origination fee. So the cost for borrowing the loan should not go over 3%. So that is one of the requirements. Okay, the guideline. The loan has not been issued as a risky or overpriced loan, high mortgage loan, and must be verifiable either by W-2 or payroll. APR that make a mortgage qualified or APR under qualified mortgage cannot be higher than a particular threshold. Okay, and they have a certain threshold for that. Special consideration, points and origination fee may not exceed 3% for loan of less than $100,000. Okay. There are 4 types of QM. General QM, originated by creditors, fully amortized schedule, 360 payments. Okay, temporary QM originated by all creditors. Also, small creditor QM, and also balloon payment QM. What is a balloon payment QM or balloon payment mortgage? Meaning that there is a loan that say you're gonna pay the same, we amortize for 30 years, right? You pay the same for 10 years, but after 10 years, right, you're gonna pay everything back, all the balance. So you either need to refinance before end of 10 years, or you have to get enough money to pay back the entire amount, remaining amount of the loan. That is what is called balloon payment. Okay, certain risky loan features are not permitted, such as interest only cannot be qualified mortgage. Negative amortization, meaning you only pay small amount that doesn't cover enough interest, then the loan keep growing. It's called negative amortization. Negative amortization cannot be considered as a qualified mortgage. Balloon payment cannot be considered as a QM. Okay, loan term that longer than 30 years. There are loan term that can be 40 years too. So anything that longer than 30 years are not considered QM. Okay, which rules are covered by the ATR or ability to repay, which is all the residential structure, including 1 to 4 units, individual condominium, cooperative. So 1 to 4 unit residential, right? 1 building, 2 building that may have 1, 2 units per building, right? Condominium, you have maybe 2-story with many units in that 2-story. Cooperative, we talk about this, in one of the class, or in the high rise. Okay, all the unit in the high rise. Mobile home, right? Mobile home can be on the permanent concrete foundation or on the trailer. Okay, trailer if it's used as a residence. Okay, so these are the loan that covered by the ability to repay. Commercial cannot be. More than 5 units cannot be. Okay, here are 8 ATR underwriting factors. Okay, so when the loan coming in, right, you get the application, you get all the conditions, you get payments, pay stuff, W-2, everything, then you send it to the lender. The lender have a division that have underwriters who gonna look at the application and all the documents, and then here are the at least the 8 rule that they use, okay, to determine of the ability to repay, which is current or reasonably expected income or asset. Okay, you have to have a good income. You have to have some asset to cover, if you need to sell it to, make payment. Current employment status, you need to be employed, right, so that you can get income. Monthly mortgage payment, okay, you need to be able to make that monthly mortgage payment. Monthly payment on simultaneous loans secured by the same property. So one property, you may have 2 loans or 3 loans. For example, right, you have the first lien, the second lien, or the first mortgage or the second mortgage. Let's say if you buy a house, $500,000 house, you borrow 400,000, right? And then you short 15,000. You can borrow a second loan for that 15,000. And now you have two loans that you have to pay for. Okay. And let's say somehow that you're still paying for those two loans, and then you take a HELOC. Then now you got three payments. Okay. Three loans. Okay. Monthly payment on simultaneous loans secured by the same property. So I just explained that. Monthly payment for the property taxes, insurance, or HOA, or other costs. Other costs probably going to include HOA as well as MLO rules, okay, or any special tax assessment. Okay, debt, alimony, and child support obligations, right? Make sure that you're able to not only pay for all these stuff, but also pay for these if you have them, right? If you meet the qualification, then you have the ability to repay status. Monthly debt to income ratio on the residual income. Okay, so you have to keep that debt to income in a reasonable percentage, like 43%, and you have a really good credit history, no bankruptcy, no late payment, your credit score is good, and all that. Okay, so all these facts are the one that they use to determine if you have the ability to repay or not. So you get a KM, which are meet the guideline. Now you get the loan program that doesn't meet the guideline, which is called a non-QM. The feature for the non-QM include it doesn't conform to the consumer protection provision of the Dodd-Frank Act. Okay, no, it doesn't meet with the Dodd-Frank Act, so it's a non-QM. Applicant whose income vary from month to month, or those with other circumstances, may qualify for these type of mortgages. Because like you don't have a W-2, you may have the same income every month. But let's say if somebody working in a nail salon, hair salon, a restaurant, waiter, waitress, bartender, gig economy, Uber driver, Lyft driver, DoorDash, blah, blah, blah. Okay, those are people with vary income per month. But as long as they can prove that they have the total an average income over a year or 2 years, right, with good documentation, with the tax, with the bank statement, then they can prove it. They take an average, okay, that each month they come out with an average, then they can determine if can be can meet with the DTI 43%, or like I said, with the non-QM, sometimes they go up to 49% as well, sometimes even slightly at 50% too. Okay. Okay, so like I said, if your DTI is more than 43%, that doesn't qualify with the qualified mortgage or the QM, then you can apply for the non-QM. With the non-QM, there's also a threshold for the DTI too. If it's too high, there's not any more loan that's gonna accept that. Ideally, 50 or below. Okay. Interest rate on loan of the QM is vary between lenders, but it's higher than the QM. Okay, non-QM loans are insured, guaranteed, or backed by the FHA, VA, Fannie Mae, and Freddie Mac. So meaning the non-QM cannot be resell to the secondary market. So Fannie Mae and Freddie Mac won't buy it. So whichever the investor that take on that loan, they either keep it or they resell it to somebody else. Okay. Who can benefit from the non-QM? The self-employed, the business owners, those with the high level of debt, those with the low credit scores, real estate investors, right? Like myself, I love non-QM, freelance or gig economy. Okay, I already discussed about that. Okay, how do lenders verify income for non-QM loans? Lender must verify and document anything that support the borrower's ability to repay, including income sources. Usually they do an average, okay, an average to find a monthly income. Verify assets or anything else that give them assurance that the borrower can repay the loan. What is the benefit of applying for non-qualified mortgage? If you have a low credit score, if you have a high debt to income ratio, income that varies enough for traditional mortgage not to be an option, okay? So like sometimes they use a stated income or a bank statement, and you look on the left side here, cannot resell, to the secondary market. DTI greater than 43%. Am I on time? Wow, I got 2 minutes. Okay, so I don't want to give you a lot of information today, but I will, give you talk more about the qualified mortgage, conforming, non-conforming, and all that too. Okay, but yeah, today we just covered two big things: QM mortgage and a non-QM mortgage. Okay, so take a look at these requirements. Okay, anybody have any question? Knock knock. Anything? How is it? Is it good? Quick and short? I talk a lot. Straight 1 hour. How you like it, Joe?
Yeah, it's more interesting than previous classes.
There you go. It's
Yeah.
activities. This is what we do. These are MLOs, right? These are the thing that we're going to get engaged, right? And I'm going to go in deep and give you more examples. But yeah, like the laws, those are boring stuff. But guess what? Those are the fundamental understanding behind that. You make sure that when you offer the activities, it needs to meet with the laws, right? To protect the consumer. The laws are there to protect the consumer. So any question on the test, if you read the question and you read the answer, any answer that protect the consumer for that particular law should be the right answer. Right? Yeah, it's more interesting, right? It's getting deep, and believe me, the way that I'm going to present, I'm going to talk, is to actually go further than from the material, from the class material, because I'm actually integrate my experience, the real life experience, real life scenarios into the teaching, so that not only help you. My goal is that I want to give you an overall understanding, the big picture of the whole mortgage lending, so that when you get into that test room, right, you don't have to draw back your class material, but because you already understand everything, it's easier for you to answer the question and pass the test. That is my goal for all of you. Okay, good stuff, huh? It seems like more exciting than for everybody, right? No boring laws and stuff. Okay, anything else? One announcement. I probably not gonna have a class on Thursday because I have another meeting going on Thursday. So we're gonna skip Thursday. We're gonna have a class tomorrow and Friday. Okay. And I'll just send out a notice too. So if nothing, have a good night.
Yep. Have a good night.
Thank you.
Mm-hmm.